The year 2020 couldn't be described any way other than strange. Here in Melbourne, we've been in lockdown for the better part of the entire year, and we've been in complete isolation in our homes over the past few months. But most interestingly, I was able to generate a 68.74% return in the stock market over the past 12 months, in the same time that the US market has returned about 11%, and the Australian market has returned an underwhelming negative 4%. So today, I'm going to be discussing 3 key actions that I took that contributed mostly to the returns that I generated over the past 12 months. And not only that, I'm also going to show you how you can take these actions in your own portfolio to improve your long-term returns. And unlike some people who post their portfolios on the internet, this isn't one portfolio out of 10 or 12 portfolios that I secretly have that you will never see, and that by chance this is the one that outperformed the market. This is everything I have invested in the stock market, and it's also the only asset class that I hold besides cash. Before we get started, I do have an update to share in regards to my e-learning platform, Learn by Example. Learn by Example is a platform and community that I run for a small group of investors to help those who understand the basic principles of long-term investing, but want to dive deeper into the analysis process. Students get access to stock analysis reports on real companies I have personally analyzed that serve as case studies to assist you in learning the analysis process. Each report comes with a 60-minute video presentation where I go through the report and explain my rationale and how I reached my conclusions. You get instant access to over 45 hours of these presentations, and I release new ones every 2 weeks. You also get access to a private community for long-term investors. I am active answering every single question in the group 6 days a week. Plus, we do a Q&A live stream every week, and there's over 30 hours of recorded Q&A sessions. And on top of all of that, there is a 4-hour program for understanding the intrinsic valuation part of stock analysis, including exercises to test your knowledge after each presentation. The community has a maximum capacity of 300 students because I want to be able to answer every single question that comes through the community and give each student the attention that they deserve. And the reason why I'm sharing all of this with you today is that currently there are only about 25 spots open, and once they are filled, there will be no more students that can get access, or no new students that can get access to Learn by Example until more spots open up, which will likely be the start of next year. So if you've been waiting to join, then now is your chance, and you can use the coupon code INVEST to get 25% off. And just for reference, 25 spots filled up in just 2 or 3 days in the last promotion that I did, which was in July. So if this is something you're interested in, take advantage of it. All the links to everything you need to know about more information and how to sign up at the discounted rate is all down in the description below. So the first action that I took that contributed to outperforming the market and delivering such substantial returns over the past 12 months was that I invested more heavily into stocks that I was more confident in. So when I was investing in the handful of businesses that are in my portfolio, I wasn't adding to these equally. I was adding to the ones that I had higher conviction, that I thought could perform better for me over the long term. And my confidence kind of comes in from 2 different angles when I'm looking at investing more heavily into a certain stock. The first is in regards to my confidence about whether it's a great business. So in other words, whether I think that it can perform better and stay stronger than its competitors in that industry. And the second angle is in terms of its price. So seeing what kind of return I can get out of that business relative to the cash flows that I'm projecting in the future. In terms of my confidence around understanding the business, I generally find 1 or less good investment every year. So I'm very, very selective in the businesses that I'm willing to put money into. And I concentrate my time on a small number of businesses. You saw my portfolio, there isn't many businesses in it, and my entire watch list isn't much bigger than that. So I'm concentrating my time on learning as much as possible about a select few industries, and then within those industries, a select few businesses. And then I am only willing to invest in a company if it is terrific, if everything looks really great for it. And finding a business like that doesn't happen very often. As I said, it's usually 1 or less per year that I find a business that I'm really wowed by. But typically I'm looking for a business that has a very, very strong track record of outperforming its competitors in a number of different aspects, in terms of revenue growth, in terms of earnings growth, in terms of the return that management is generating, in terms of having a better financial position, just to give you a couple of examples. And then my other angle of confidence comes from how cheap the stock is, the price of the stock. So when I'm saying how cheap it is, with every business that I look to invest in, I make a projection of what the future cash flows will likely be. What can I get out of this business, or reasonably expect to get out of this business in the future? And I compare the stock price to those future cash flows. And in businesses where the stock price is really low relative to those future cash flows, I'm very, very confident. A lot of the popular tech stocks that you will see at the moment, a lot of them are priced so high that in order for you to just make an 8% return, a 12% return on that stock, they would need to grow 20, 30, maybe even 40% per year in terms of their profitability growth, growing their earnings per share, growing their cash flows. So with those businesses, the expectations and the requirements for performance are really, really high. Whereas I try to look for businesses where the expectations are really, really low, where it's a business that's been beaten down by some kind of short-term problem. The stock has just gotten substantially cheaper, but the underlying business has not changed substantially. And as a result, there is a really favorable relationship between the price I can pay for that stock and what I expect to get out of it in the future. And this is the way that you should think about it. As the stock price of a great business goes down, the amount of profit that that business needs to produce in the future also goes down. So in order for me to achieve a return that I'm targeting, say 15%, as that stock price goes down, the business doesn't need to perform as well in the future in order to generate me that return. And the opposite is also true. If you're buying into a stock that has a PE of 100 or a PE of 200, or something like a Tesla that had a PE of 1,000, for example, that business needs to grow at such a huge rate just to deliver you average returns, just to deliver you any resemblance of returns in terms of real cash coming to you as an investor. So in 2020, I figured out which businesses I was the most confident in terms of thinking it's a really great business that's better than its competitors, and in terms of its price. And I invested the most money into the businesses that I was the most confident in. And the result was that I was able to generate really high returns in the businesses that I was really confident in. So now I just want to show you a comparison in terms of which businesses I invested the most money in, and by relation was the most confident in, and then the return that each of those businesses generated, to see, well, were the businesses that I thought could deliver me the highest return, did those businesses actually end up delivering me the highest return? So from top to bottom, in order of how much I invested in these companies, we had Corporate Travel Management at the top as the most, then Thor Industries, then Texas Roadhouse, and then Facebook, and then at the bottom we had YY Incorporated and National Australia Bank, and I invested no money into either of those stocks. And if we compare that to then the percentage return that each of those businesses delivered me, we have at the top Corporate Travel Management, second, Thor Industries, then Texas Roadhouse, then YY, Facebook, and National Australia Bank. So what you can see is the order of how much money I invested into each based on my confidence, and the order in terms of the percentage return that each delivered are pretty much identical. They're very, very similar. And of course, it's not always going to work out as neatly as it did for my portfolio in 2020, but the principle still applies. You should want to put more money in the businesses that you have studied the most and that you have the most confidence that they can deliver you an above average return over the long term. So in other words, focusing on businesses and industries that you understand the most, and looking to invest in businesses that offer the best relationship between the price you pay today and the future profits that you expect out of that business. And if you do that, you will likely do very, very well over time, even though as a nature of stock market investing, you are going to make some bad investments over time. The second action that I took, or in this case, it's kind of an inaction that led to or contributed to the performance of my stock portfolio, was that I didn't try to time the market. So for those who don't know, timing the market is the idea of trying to predict when a stock has finished falling and buying it so that at kind of its lowest point, and then trying to sell out at its highest point on its stock chart. That is not something that I did. What I did was I invested in these companies when the price made sense compared to future cash flows. And that is distinctly different to trying to time the market and figure out where the stock will go in the short term. And when you're investing like I did, where I'm not trying to figure out where the bottom is, but rather just looking at the price of the business and comparing it to my estimations of what the business can deliver in the future, as a result, there is a high likelihood that when you invest like that, the stock is going to go down, and maybe even down substantially after you invest in it. And that was the case with most of the businesses that I invested in 2020. If we take corporate travel, for example, it went down 74% after I first invested into it. We can take a look at Thor Industries. That went down 35% after my 2020 investment. When I buy into these stocks, I just accept that I have no idea what the stock is going to do over the next 1, 2, 3, maybe even more years. I have no idea what the stock is going to do. But what I am confident in is that over the next 5 to 10 years, the business will deliver me profits that far exceed the price that I paid for that business. So that means that sometimes the stocks that I invest in are going to be negative in the short term for a significant length of time. Thor Industries, for example, was my worst performing investment in 2018, and it was negative for well over a year, but is now the stock in my portfolio that has generated me the greatest growth in my portfolio. And for other stocks, they're going to just go straight up after you invest in them. Facebook being one of them. After I invested in 2020, the stock pretty much went up in a straight line and at a pretty substantial rate. So the key lesson here is you should stop trying to predict what the stock market is going to do or what a particular stock is going to do over the next few months, and instead try and come up with a reasonable estimation of the profits that that business can produce over the next decade. And when you have that long-term view of the underlying business rather than a short-term view of the stock price and the stock movements, you will likely do substantially better over time. And just one other thing to add to that point, if you take my Thor Industries investment, for example, I could have easily sold out of that investment at a loss well after a year after I first invested in that company. But the reason why I didn't, and the reason why I consistently added more to it, was because I was very, very confident that the underlying business was strong and the stock price was not reflecting the value of that business, the long-term value that it can deliver over the next 5 to 10 years. So if I had sold out of Thor Industries after a year, I would have been negative. If I had not added more to that position after I first invested in it, I still would be down on that position as well. So the only way that this is a stock that generates the most money in my portfolio is if I'm consistently buying more because I'm very confident that the market is mispricing that stock. Okay, so that is what you need to do. Focus on the underlying business and focus on the underlying business with a long-term perspective. And the third action that contributed to the performance of my stock portfolio in 2020 was that I held cash. So prior to the crash in earlier 2020, I had 60% of my stock portfolio in cash. And again, this isn't timing the market. I didn't sell out of the market expecting that there was going to be a crash in 2020 specifically, or in March of 2020 specifically. I just had more cash naturally because there was a lack of investment opportunities. And after the crash, some opportunities opened up and I invested a substantial amount of that cash to the point where in March, after the crash and after I'd made a number of these investments, I was about 80% invested in the stock market with about 20% in cash. So if you have a disciplined approach to selecting stock market investments like myself, you will see your cash pile go up when stock prices are expensive, and it will go down probably rapidly when opportunities open up. And that window of opportunity can sometimes be very, very short. For Facebook, it was not that short, I guess. It was about 6 months during 2018 that the stock reached a price that I was willing to invest into it. For Texas Roadhouse, it was less than a month. It was about 2 or 3 weeks in early 2020 that it reached a price where I was happy to invest a substantial amount. So most of the time, you're probably going to be doing nothing. And by doing nothing, I mean all you're going to be doing is taking a portion of your income, whatever percentage you're setting aside, and setting it aside as cash in your investment portfolio and wait for opportunities. And usually what will happen is there will be some kind of short-term problem that is looking to last 6 to 12 to 24 months. And that could be a short-term problem with just the business specifically. It could be an industry-wide problem, like a shortage or something like that, or inflation, or it could be a broad economic problem like we've seen in 2020. But any of those things can cause the stock price of a great business to get really, really cheap. And it might not be cheap for very long, but if you're ready, you have your watch list of great businesses and the prices that you're willing to pay, you can then quickly deploy a substantial amount of cash, like I did, where I went from about 60% cash down to about 20% cash and about 40% invested in the stock market to 80% in the stock market within the space of about a month and a half. Now, of course, this is just a snapshot of my portfolio about 9 or 10 months into 2020. So, of course, naturally, this stock portfolio and the performance of it could change substantially before the end of the year. It could go up substantially, it could go down substantially, but towards the end of the year, as always, I will be doing my yearly portfolio review where I go through each of my positions, my investments that I made, and ultimately the overall return that the portfolio generated, and to compare that to the Australian and US markets. So at the end of the year, we can reflect back and we can have a look at how different my portfolio performance is from where it is right now. But if you're interested in learning more about how I analyze businesses and find great businesses and buy them at appropriate prices, and you're new to all of this, then I highly recommend you check out my 4-step stock analysis playlist on my YouTube channel. Just click on my name and then click playlists, and it'll be one of the playlists there. And then of course, check out all of the other free content that is available. And if you've been looking at this stuff for a while, you understand the basics of what I'm doing here, what I'm teaching here, but you're ready to dive deeper into the stock analysis process, then I highly recommend you go and check out Learn by Example. Get 25% off, use the code INVEST, and join while there are a few spots still available. And as I said at the start, all of the information about how you can contact me if you have any questions, how to sign up at the discounted rate, and then all of the information about the platform is linked down in the description below. But with that said, I hope you guys enjoyed today's video, and as always, I put a ton of effort into this one, so I'd very much appreciate it if you could leave a like on the video and head down to the comment sections. Let me know what your thoughts were. If you have a question or anything you want me to cover in a future video, then let me know down there. I'll be answering questions as this video goes live. But besides that, hope you guys have a great weekend, and I'll see you in the next video.